Hi, everyone, and welcome to our Cherry Beckert webinar today. We have great content planned for you, and we're offering up to 1 hour of CPE for this session. Now, before we get started, we have some housekeeping to run through. In order to receive CPE credit, you must answer at least 3 polling questions. We will be launching 4 of those today and attend for the full 15 minutes. Now, we will also be sharing a short survey posted at the conclusion of this webinar. We value your feedback and just ask that you take part. We will be issuing CPE certificates by email within 10 days. If after 10 days you have not received one, please reach out to cbhlearning@cbh.com. We'll also be posting a recorded version of this webinar available in about a week. It'll be posted to our website and also sent via email. Now, if you have any questions during the webinar, please click on that Q&A window located in your control panel. We will address any that we have time for, and if not, we will be collecting those responses and follow up later. With that, I am pleased to welcome Michael Hoos, Director with Cherry Beckert, to provide an annual accounting and auditing update. Michael, take it away.
Thank you very much. Thank you everyone for attending. My name is Michael Hoos. I'm a director in professional practices. I spent a good bit of my time analyzing new accounting and auditing standards, doing QC reviews, and developing learning content such as this. And I'm excited to kind of go over some of these new standards that are going to be impactful for this coming busy season and going into the future. Now, I want to acknowledge before we get into this that it's impossible to go over every single ASU that's out there. So we're going to go over the ones that I feel might be most impactful to the audience. And so we're going to kind of break it down like this. We're going to start with the impact of SAS 134 to 141. So it's actually going to be an auditing standard, and it's going to be very brief. And I just want to talk with you about it so that you're not surprised by some of the changes you might see from your auditors. And then we're going to go into ASUs that were issued in 2021. Many of those you'll want to early adopt, as you'll see as we go through. And then ASUs effective for 12/31 calendar year end, so for this upcoming year end. And then lastly, we're going to talk about ASUs that are effective in 2022. So you'll have to start implementing beginning in January. So let's go ahead and jump right in to that auditing standard. So the reason I'm talking about an auditing standard in a A&A update that's predominantly for folks that maybe not be auditors is that there's going to be some changes, and we don't need to know all of these changes on the slide here. What you basically need to know is that your audit report is going to look different, and you also are probably going to have a different looking engagement letter if you haven't signed it already. And so how is that audit report going to change? Well, prior to this adoption, the audit report was broken down like this. It started with management's representations or responsibilities, excuse me. And then second paragraph would be the auditor's responsibilities. And then lastly would be the opinion. Now, after adopting all of these, you're going to start with your opinion first. Then you're going to have a basis for opinion paragraph, then management's responsibilities, and then the auditor's responsibilities. And you're going to see some wording changes, like defining what reasonable assurance is, and some wording changes in the management and auditor's responsibilities paragraphs. So that's really all you need to know, unless you're an auditor, that this is pretty much all you need to know as far as the ASUs 134 to 141. And let's start with our first polling question. And that is, do you think having the opinion paragraph first is a good idea? And so the background of this ASU was that they were thinking that opinions weren't providing enough information, and that they weren't, they were too cookie cutter and that kind of thing. And so I find it a little bit weird that they're going to start with the audit opinion now, because that might make folks just immediately, look at the audit opinion and move on and not get any additional information from the total audit opinion report. And so what this SAS 134 to 141 also does is that it introduced TAMs, right? And so that is, key audit matters that that would kind of describe a little bit more, in detail what we considered the risks were and what our audit responses were and that kind of thing. So again, kind of having that that opinion first could potentially circumvent kind of the purpose of this SAS 134 suite. So that's the impact of SAS 134 to 141 as far as anyone who's not an auditor needs to know. Let's get into the meat of the presentation, and that is the ASUs that were issued in 2021, and then we'll go through some of the other ASUs that are effective and such. So the first ASU that was we're going to talk about is 2021-10, and that deals with disclosures by business entities about government assistance, something that's probably on the top of the mind of a lot of folks considering the pandemic and the PPP loans and that sort of thing. So this ASU only applies to entities that are not for profits or under 958 or certain employee benefit plans. So it applies to pretty much most entities except those. And what it requires is the following to be disclosed about transactions with a government that are applied, using the grant or contribution model by analogy. And that is information about the nature of the transactions and the accounting policy used to account for them, the line items and amounts on the balance sheet and income statement that are affected by those transactions, and some of the significant terms and conditions of the transactions, including any kind of commitments or contingencies, that sort of thing. This ASU is going to be effective for all entities that are within its scope for financial statements issued for annual reporting periods beginning after December 15th, 2021. So 2022 calendar year ends. Early application is permitted and highly recommended, I would say, given the fact that we know that this is where the FASB wants us to go. An entity should apply these amendments either prospectively or retrospectively. The next ASU I want to talk about is ASU 2021-09. And this deals with the discount rate for lessees that are not public business entities, okay? So obviously the first bullet point only applies to private entities. It's an optional standard, right? You don't have to apply it. And it only applies if the rate that's implicit in the lease is not determinable. Now, in practice, the rate that is implicit in the lease is almost never determinable from a lessee's perspective. And the second to the last bullet point, the change that this ASU does is it allows a private entity that can not determine the rate that's implicit to apply a risk-free rate on a class-by-class basis instead of entity-wide. So it used to be that if you wanted to do the risk-free rate, you had to do it for the whole entity-wide, all the leases. Now you can do it on a class-by-class basis. So all vehicles or all buildings, that sort of thing. And of course, like most practical expedients or exceptions, if you elect this, you need to disclose information such as what asset classes that you applied it to. This ASU is effective for entities that have already adopted 842 for fiscal years beginning after December 15th, 2021, so 2022 calendar year ends. And then for entities that have not yet adopted 842, the new lease standard, you're required to adopt these at the same time that you would adopt 842. So 842, we're going to talk about that near the end of the presentation. Most folks are going to have to adopt that in January. Early application is permitted, and I expect most folks to use that if they're eligible for it, and you would apply it on a modified retrospective basis. The next ASU I want to talk about is ASU 2021-08, and it deals with accounting for contract assets and liabilities that are governed under 606. And really what this deals with is it deals with business combinations, all right? And so if anyone's ever been through business combinations under 805, you'll know that generally the rule is you recognize everything at fair value at the acquisition date. And that can create some problems here, right? And so the main problem that I've experienced in my career is related to like deferred revenue, right? So revenue that you've been received money for, but you haven't yet provided the services, or for whatever reason can't recognize revenue under GAAP. And Sometimes what happens is that when you do an 805 transaction, a business combination, and you measure that deferred revenue that's on the acquiree's books at fair value, you end up recording a fair value that's significantly less than the acquiree's carrying value. And that creates what is sometimes called lost revenue. So that revenue was never recognized on the books of the acquiree, and it's reduced in value for the acquirer after the business combination, and you never get to recognize that. And so that kind of creates some issues. And there's some other issues that kind of came about when 606 was adopted and how that interacted with 805. And what this ASU does is that first bullet point, it requires, right, it's not optional, it requires an entity to recognize and measure contract assets and liabilities that are acquired in a business combination in accordance with 606. So you use that unit of account and you use that measurement method in accordance with 606. And the second bullet point, generally, this should result in acquirer recognizing and measuring acquired assets and liabilities related to a 606 contract the same way that they were measured and recognized under the acquiree's financial statements, assuming the acquiree was doing it in accordance with GAAP. Now, the key thing here is that third bullet point, it does not apply to other assets or liabilities, for example, refund liabilities or customer-related intangible assets, that kind of thing. It really just relates, from a practical perspective, mostly for deferred revenue, but mostly technically just relates to contract assets and contract liabilities under 606. This ASU is effective for public business entities beginning after December 15th, 2022. And then for all other entities, it's effective for fiscal years beginning after December 15th, 2023. It's applied prospectively. And the last bullet point, early adoption is allowed. And when you early adopt, you should apply it retrospectively to all business combinations that occurred in that year of adoption. And I expect that many folks will want to early adopt this, given the fact that, as I mentioned earlier, many times those, quote unquote, lost revenue, right? The next ASU I kind of want to talk about is 2021-07. And this one deals with determining the current price of an underlying share in equity classified share-based awards. So any private company participants out there know that when you issue share-based compensation, that under 718, you're supposed to value that. Most often people do it through the Black-Scholes model. And the Black-Scholes model will require you to, one of its inputs, key inputs, is the fair value of the private company shares. Now, for a public company, that's pretty easy. You can go on a Yahoo Finance or wherever it's freely traded, you know what the share price is. For private companies, it's not readily available, all right? And so that kind of created a lot of issues where, well, people would have to go out and get an expensive third-party valuation of the entire company and the particular underlying share of that stock option. And so now what this ASU does is it says, if you're a private company, and it's only available for private companies for obvious reasons, and it's optional, you can still do it the old way. What it does is, if elected, it allows you to determine the fair value of the entity's own shares as long as the entity uses a reasonable application, quote unquote, of a reasonable valuation method. Now, obviously, what does that mean? Who decides what's reasonable? Well, I think the real key here is that second to last bullet point, and that is it explicitly states that a valuation done within section 409A of the Internal Revenue Code is an example of such a method. And so always it's a good advice, you need to get a 409A valuation if you're going to issue these shares to avoid tax penalties and that kind of thing. And so if you're already getting that for 409A purposes, then this can be potentially helpful in that you don't need to then also get a valuation for, say, 718 purposes, right? And of course, the ASU, because it says reasonable application and reasonable valuation method, it provides some criteria to consider and that kind of thing. But I think the key thing here is that most folks now can use their 409A valuation. This ASU is going to be effective prospectively for awards granted or modified during fiscal years beginning after December 15th, 2021, so 2022 calendar year end. Early application is permitted if your financial statements have not been issued as of the date of this ASU was declared. And so I anticipate that most folks are going to want to early adopt this because it should save, hopefully, some funds that you otherwise would have had to spend on, getting evaluation, that kind of thing. So I expect most folks will want to early adopt this. The next ASU I want to talk about is ASU 2021-05. And this one deals with lessors and their accounting under the new lease standard 842, specifically as it relates to your variable lease payments, right? And so let me kind of break this down. Prior to this ASU, a lessor's accounting under 842 was a whole lot different than it was under the old lease standard 840. And you would have a sales type or a direct financing type lease, and you would basically put an entry that is a debit to your net investment in lease, which would be the present value of all quote unquote lease payments. And then you would have a credit. We'll go to the bottom line there. You would de-recognize the asset. So you're removing the asset and you're putting on this net investment in lease. And that net investment in lease would be measured as the present value of all lease payments. Well, the present value of all lease payments under 842 is all of your fixed lease payments and variable lease payments that are tied to like an index, right? So if something is not tied to an index, say, for example, in the electric companies tied to kilowatts or that kind of thing, then that would not be included in your present value of lease payments. So you de-recognize this asset and you would recognize a net investment in lease, but that didn't include all the payments you were really expecting. And so that would create a day one loss, as you see on the screen. Well, what this ASU does is it says that if you're expecting a day one loss, right, because of these variable lease payments, you can, instead of classifying it as a sales type or direct financing type lease, you would just recognize that lease as an operating lease. So what that means is there'd be no balance sheet impact. You wouldn't remove that asset and bring on a net investment lease. You would continue to depreciate the underlying asset that you're leasing, and you would just recognize the income, the predominantly variable income, as it becomes due. And so that's pretty helpful for those who might have had to recognize a day one loss. This is effective for annual periods for fiscal years beginning after December 15th, 2021, if you're a public business entity or a private business entity. And you can early adopt this, but of course not before adopting 842. That wouldn't make sense since it's really kind of a tweak to 842. The next ASU I wanted to talk about that was issued in 2021 is ASU 2021-04. And this one deals with an issuer's accounting for certain modifications or exchanges of freestanding equity. So basically, if you have some warrants out there or some options that are not governed by 718, they're not employee-based options. So generally going to be warrants. And sometimes what has happened, and I've experienced this in my career, where there'll be a modification and there's not, any great guidance that tells you how you would account for that modification. And for those of you who are familiar with modifications to any kind of share-based compensation, whether it's to employees or not, when you have a modification, you generally measure that stock-based comp at the day of the modification prior to modifying any of the terms, and then also measure it after the modification with modified terms. And that delta, that difference, would be the measurement amount. And then the question became, well, what do I do with this measurement? Do I recognize it immediately? What do I characterize it as? That kind of thing. So what this ASU does is it applies to all modifications or exchanges of equity classified instruments, as long as they remain equity classified. So if you're going from, say, a warrant that's equity classified to making it liability classified for whatever reason, then this would not apply. And the concept is that the accounting for the transaction for this modification in your share-based comp should not differ than what you would have to account for if you were paying cash instead of modifying warrants. And so that means that the incremental value of the modification or exchange, it would be attributable, say, if you have an equity offering, as equity issuance cost, right? But let's say that this wasn't related to equity, but debt. So let's break down debt a little bit, right? So first, let's talk about if I was issuing new debt, right? So I don't have existing debt that I'm modifying or extinguishing. I'm just entering a whole new debt arrangement, right? So how you would account for that modification depends upon who the warrant holder is. If the warrant holder is, say, the lender, then you would account for that incremental value as debt discount. And of course, you would amortize that into earnings through your effective interest method. But if that warrant holder was not the lender, say he was an accountant or a lawyer, that incremental value would be treated as debt issuance cost, and that would also be amortized through earnings under the effective interest method. And so that's new debt. Let's say that you have existing debt, which is probably more likely the case, and you are modifying your warrants or whatnot that are related to that existing debt. And so for those of you who are familiar with any kind of modification to debt, you end up having to perform what's called like the 10% test, and you determine if there's a 10% difference in the old debt, quote unquote, and the new debt that's being modified. And if that's the case, then you account for it as the debt extinguishment model. And if that's not the case, then you account for that modification under the debt modification model. And those modifications to those equity instruments will depend upon what model you're under. So whether you are above that 10% threshold or not, and also who the holder is. So if you're in the debt extinguishment model and the holder is the lender, then you would expense that delta, that change in value, right? And if the warrant holder was not the lender and you're under debt extinguishment accounting, right, that first column, then you would capitalize that. Now, if you're under modification model, so you didn't pass the 10% test, you're less than 10% difference in value between the old debt and the new debt, then if the warrant holder is the lender, you would capitalize it. And if the warrant holder was not the lender, say an accountant or a lawyer, that would be expensed. And so that's when you have equity instruments that are tied to the warrants that you're modifying, or debt instruments, new or modified, that are related to the warrant. But then there's also goods or services. Like a service provider or someone who sold you goods has warrants and you modify them. And what the ASU says is you basically need to apply judgment in that situation, right? So more than likely some sort of impact I would expect to your P&L. And the last bullet point is it says that if your modification to these warrants are not related to anything we just discussed, and not related to the transfer of goods or services, or an equity raise, or new debt, or modification or extinguishment of existing debt, then you treat it as a deemed dividend. And what a deemed dividend basically means is that you're transferring wealth from one set of equity owners to another, the warrant holders, if there's an increase in value for those warrants. So this ASU is effective for annual periods, fiscal years beginning after December 15th, 2021. And early adoption is permitted, and the transition method would be prospective. And so I imagine most folks to want to early adopt this one as well, since it clarifies guidance that there might have created diversity in practice previously. The next ASU I want to talk about is 2021-03. And this one deals with accounting alternative for evaluating triggering events. Now, this is only available to private companies, and it's optional, and it only applies to goodwill. And that's where I think a lot of the errors can get made, is some folks might try to analogize this to other impairment testings and that kind of thing. And so what you see on the screen here is a graph of unemployment. And as we all have lived through, in 2020, around the March timeframe, March to April, the pandemic hit full force and unemployment rose sharply. And then gradually over time, according to the year end, it went down to a better amount and it's continued to go down. And so the question arose is, well, okay, technically, if I read the guidance, I'm supposed to evaluate goodwill continuously. So that means that if, say, in March or April of 2020, things looked really grim as they did, I would have technically had to impair my goodwill. But then at year end, as things got a lot better, I would say, well, shoot, that goodwill that I impaired doesn't really look like it needs to be impaired at year end. But the accounting guidance didn't match up with that. And so what this ASU does is it says, if you're a private company, and if you're doing this related to goodwill and goodwill only, you could evaluate your goodwill impairment at the end of the year and not theoretically continuously. So in the situation at year end, if your company was doing much better, you might not have to have a goodwill impairment. And so that brings us to our second polling question, which is, did your organization have any impairment as a result of the pandemic? And so that's something that was high on the list of people to analyze. It was in all of the interpretive guidance that was out there, was talking about how you needed to, obviously assess goodwill, we just talked about, but other intangibles, trade names, that kind of thing, anything that might be created in an 805 transaction. People were analyzing them, investments, that sort of thing. People were analyzing them, and we were expecting lots and lots of impairments. And for SEC filers, which this ASU we just talked about doesn't apply to, they would have to report on a quarterly basis. And so they did experience quite a lot of impairments. But my expectation is that for many private entities that, whether they applied this ASU or not, at the end of the year, they probably didn't recognize a whole lot of impairments. And looking at the results, it looks like 88% of you agree that you didn't have any impairments as a result of the pandemic, and only about 10 to 12% said you did. So that's about aligned with what I would expect. The next ASU I want to talk about that was issued in 2021 is 2021-02. And this one deals with franchisors and the revenue recognition under 606, all right? And this only applies to private entities, and it's optional, right? So you don't have to apply this, but as you'll find out shortly, everyone's gonna probably want to apply it who's a franchisor, right? So the background of this is that historically franchisors, they would charge like an upfront franchise fee, right? And it would be, either explicitly or ostensibly for various different activities. And historically, before 606, most of the time that would be recognized after those activities, those upfront activities were complete. But after 606, many firms interpreted 606 as saying, well, those upfront fees, they have to be spread out over the term of the franchise license, right? Which could be a pretty significant period of time. And so that was a big change for a lot of franchisors. So what this ASU does is it clarifies technically, doesn't technically change things, but clarifies that if there are certain pre-opening activities in those, and they specifically list them and they're on the screen for you, if they are one of the pre-opening activities that's specifically listed, that you can consider those being distinct. And so, as you all probably know from 606 adoption, in order to recognize something separately, it has to be distinct. And so previously you were not considering those things distinct and they were grouping them with the license. Now you consider them distinct if they meet this list, and so you can recognize them separately. Well, we've kind of analyzed this as a firm and kind of thought through some of the risks, right? And some of the risks I think are worthy of sharing with you is that it doesn't allow all pre-opening services to be recognized as distinct, only those that are listed. So you need to make sure that if you want to apply this, you make sure that those activities meet the descriptions that are in the new standard. The second bullet point here is that it does not alleviate the requirement under step 4 of 606, which requires you to allocate your transaction price to the different distinct performance obligations. So if you have a franchise agreement and there's a contractually stated amount for these upfront activities, you cannot presume that that contractually stated amount is what should be allocated under step 4. You still need to go through the step 4 process of determining the relative standalone values of each of the performance obligations and recognizing based upon the relative standalone selling price. Now, the last bullet point is one that I particularly want to hit home, which is that you must apply this retrospectively, right? And that could create what is, I've talked about already as far as 805, lost revenue. So let me kind of elaborate. Let's say that I'm a franchisor and in the prior year, I had adopted 606 and I had changed my revenue recognition so that these upfront fees were not recognized immediately, but rather deferred over the license agreement, right? So I didn't recognize them in the prior year, but now in the current year, I want to adopt 2021-02. And I have to apply that retrospectively. So what does that mean? I mean, what that means is I go back into the prior period and I recognize that upfront revenue that I had previously had to defer before this ASU was issued. So it creates lost revenue in the sense that there will be no current year financial statement that you issue that recognizes that revenue, right? So you would push the revenue into the prior year that you already reported on. And in the current year, you would not be deferring it or recognizing any of it. So it's essentially kind of lost in a way. And so that's something to think about when you're considering this ASU, because it is, you're allowed to early adopt it. You're not required to adopt it until you adopt 606. And so this is something that I think you need to be really concerned about if you want to kind of early adopt it. The next ASU that was issued in 2021-01 is 2021-01, and that deals with reference rate reform. All right. Now, some of you might remember back in like 2012, there was, some scandals related to LIBOR, the London Interbank Offered Rate. And what that basically was is LIBOR was essentially a theoretical rate that banks would lend money to each other for. And because it was mostly theoretical, there was manipulation that occurred that would increase LIBOR. And because many debt arrangements and other arrangements are tied to LIBOR, that could create an incentive to increase the LIBOR rate or manipulate it in some way. And so as a result, in July of 2017, the UK's Financial Conduct Authority announced that it would no longer persuade or compel banks to submit LIBOR as of the end of 2021 this year. And so what that means is non-USD LIBOR will not exist anymore as of December 31st, 2021. And USD LIBOR is also going away, and that will not exist past June 30th of 2023. So naturally, if many agreements, mostly debt, but could be any agreement, is tied to LIBOR, well, what replaces it, right? What's the reference rate was LIBOR, what's going to replace it? Well, the Federal Reserve has identified a SOFR, the secured overnight financing rate, as a preferred alternative, right? Now, that doesn't mean a lender has to use that, but that's what the Federal Reserve has said. And what entities listening need to do is you need to identify all agreements that contain LIBOR, right? Look and see if there's any kind of fallback language, if the reference rate goes away. And you identify all those, that's your first step. And then the next step needs to be to negotiating with the lender or the lessor, whoever it might be, what type of arrangement it might be, to make sure that you're made whole and that you're not receiving a raw deal, if you will, when they switch from LIBOR to say SOFR or something else. But the question became, well, how do I account for this change in reference rate, right? Is this a modification? Does that mean that I have to analyze debt extinguishment or modification accounting, as I spoke about previously? Or does that mean that my hedge instrument needs to be designated and I now have to recognize all of that through income, right? These are the things that you would normally have to do if you changed the interest rate. But in this case, you're changing the interest rate not because you negotiated something differently, but because the underlying reference rate is going away. And so what this ASU does is it's optional, but you cannot apply it to modifications that occur after December 31st, 2022, so the end of next year. And so it's a little bit different than most ASU effective dates in that most ASU effective dates say, this period going forward, and this one says, well, this period in the future going backwards. And the reason why is because the nature of this, which is that they don't want to extend this indefinitely, or else you would kind of circumvent the whole purpose of accounting for hedge modification or debt modification. So they're basically giving you a window to say, hey, during this window, if you apply this consistently to all eligible contracts that are within the same codification topic, so hedges, or debt instruments, lease agreements, that kind of thing, that third to the last bullet point, generally, you can consider this a non-event, more or less, right? You change your documentation, but you are not required to remeasure at the modification date or do any kind of reassessment, for example, of whether your hedge is effective or not. And you need to update your documentation, that second to last bullet point, and that needs to be done before your report issuance if you're a private company, or the last bullet point if you're a public company during the quarter of adoption of this ASU. So that's the ASUs that were issued in 2021. Let's move on to some of the ASUs that are going to be effective for this coming calendar year end, 12/31/21. Okay. Now, as we talked about, many of the ASUs that were released in 2021 simplify things or clarify things that are probably going to want to be early adopted, right? So these are the ones that you're just absolutely required to adopt as of your reporting period 12/31/21. And the first one is quite a lengthy ASU that we're not going to have time to go into detail with. And that is ASU 2017-12. And it deals with hedging, okay? And if anyone's familiar with hedging, that is that when you enter into a hedge relationship, you're trying to offset the change in value of some other instrument that you're hedging against. And when you do that, you have to assess the hedge effectiveness. In other words, how effective is my instrument at offsetting the value of whatever I'm trying to hedge, right? And so normally it would be between 80 and 125% the value of your hedge instrument offset the underlying transaction you're trying to hedge by 80 to 125%. It was considered effective, but you would have an effective portion and an ineffective portion. So the portion that's not effective at hedging against the change in value of whatever the underlying instrument that you're trying to hedge against is. And so previously to this ASU, you would end up recognizing the non-effective portion always into net income, never into OCI. And there was some diversity in practice on how you might classify that. Would you group it in with the effective portion or not? And so what this ASU did is it basically said the entire change in, say, a fair value hedge would run through net income. So both the effective and ineffective portion. For a cash flow hedge, the entire change, effective and ineffective portion, would run through OCI. And say a net investment hedge, say in maybe a foreign subsidiary, that entire change, effective and ineffective, would run through your currency translation adjustment in OCI. And so that was a nice clarification and improvement, but it also made many other changes as well, which we'll kind of briefly talk about. So we've already talked about the very first box to the left. The second one is it allows hedging of what's called risk components. And so what risk components are is that if I'm in a contract, let's say I'm in a contract to purchase many vehicles, right? A fleet of vehicles. And there's variable pricing. And that variable pricing is explicitly stated in the contract as being tied to, say, a portion of the variable is tied to the price of steel, right? What this says is that if it's explicitly stated in the contract and you want to hedge that just nuanced little piece, and in my hypothetical example, say the price of steel, you can do that now. Whereas previously you had to hedge the entire change in cash flows between the contract that you're trying to hedge against and your hedging instrument, right? Which many times would create ineffective hedges, right? So that's one pretty big change. The third box, which is that it allows hedging of non-benchmark interest rates for variable rate debt. And kind of related to that, the fourth box, which is that it adds the SIFMA rate to as an eligible benchmark rate for fixed rate debt, right? And so that's the Securities Industry and Financial Markets Association municipal swap rate. Also, not on the screen, but a little nuanced tweak to this is in 2018, they issued 2018-16, which also added the SOFR rate, which we talked about with reference reform, and the overnight index swap rate is also benchmark rates that you could use as well, right? And that's for fixed rate debt. It had to be a specific rate that's listed in the standard. The second to the last box on this is that it allows a qualitative analysis, right? And so for those of you who are very familiar with hedging activities, you would end up many times having to do a quantitative analysis, determining whether or not that offsets the value by 80 to 125%. And what this allows you to do is, even if it's not a perfectly hedged instrument, let's say it's 85% offsetting the value of whatever you're trying to hedge against, that hedging instrument, even if it's not perfectly effective, right? You would do your initial quantitative assessment, and if you consider it to be highly effective, you could then, going forward, apply a qualitative analysis, which is much cheaper and easier to do. Generally, quantitative analysis requires that regression analysis to determine whether it's 80 to 125% offsetting. So that was a very big relief. And it also did several other things. they changed the critical terms match. So it used to be that if you didn't want to do that quantitative analysis, you ended up having to take that underlying instrument that you were trying to hedge against, and you would have to match up like the critical terms. Like for debt, it might be the principal balance, the payment dates, interest rates, that kind of thing. And you would have to match them up exactly. Now you just have to match them up if it's a forecasted transaction within a 31-day period. And so this is really helpful to a lot of companies that want to apply hedge accounting, but don't know, for example, exactly what date I'm going to sell something within a 31-day period, or they have variable sales throughout the month, but they're more or less stable on an aggregate level. Every month we know we're going to get 10 million of sales in euros. Now you can hedge against that using the critical terms match, as long as it's within a 31-day period of when you think those transactions are going to settle. It also changed some rules regarding documentation, and a little bit more nuanced, changed some rules regarding when you originally applied a shortcut method and you have to switch to a long haul method. Again, the details of that are a little bit beyond the scope of this presentation, but just be aware of that. And so this ASU was originally effective a number of years ago, but ASU 2019-10 changed the effective dates. For public business entities, they were required to adopt this for fiscal years beginning after December 15, 2018. So they've already adopted it, but for all other entities, because of 2019-10 that extended the effective date, they're now only required to adopt this for fiscal years beginning December 15, 2020. So in other words, for this coming year end. The next ASU that's going to be effective for this coming 12/31 year end is 2018-15, which deals with a customer's accounting for implementation costs that are incurred in a cloud computing or a CCA arrangement. All right. And so the whole purpose of this is to align the accounting for implementation costs for a CCA, which is becoming far more prevalent. Most entities now are using a service provider, a cloud computing, or even infrastructure as a cloud. They are moving towards that. And so previously, if you were to build or buy internal use software that you downloaded onto your own servers or hardware, that there was specific guidance. 35040 would say, hey, you've got to capitalize certain of these costs and you expense certain of these. But then this kind of prevalence of the CCAs created this issue where folks said, well, substantively it's the same thing, but there's no guidance that tells me, right? And so this will change the timing of your income statement recognition of those costs. It only applies to hosting arrangements. So when you're a SaaS or infrastructure as a service, right? So you're not having a license that you're downloading or have the ability to download. And because of this ASU, you're now required to defer those implementation costs. And these terms will be very familiar with anyone who's had to use 35040 in the internal use software. You capitalize those implementation costs that are incurred during the application development stage, and you amortize them over the term of the hosting arrangement. Now, the term of the hosting arrangement will include your non-cancelable terms plus any renewal options that you're reasonably certain to use. That term reasonably certain is a pretty high threshold. Many consider it to be 90% or more. This applies to both internal and external costs, right? And so that's something that many folks get wrong. You can apply it, you're required to apply it to an internal cost, but that would only be payroll-related costs like employee benefits that are directly spent on a project. G&A and overhead would not be capitalized. You have to cease capitalizing when you go live. And that last bullet point, the unit of account is a software module or component. And that kind of works in tandem with the second to the last one, which is when you cease it, you would cease it based upon a module. So if you're building multiple modules, you would capitalize and you would have a cease date for each module or component. This ASU is effective for fiscal years beginning after December 15th, 2019, if you were a public business entity, or for most folks listening, private entities, it is effective for this coming year end, December 31st, 2021, if you're a calendar year end. And that brings us to our third polling question, which is, does your entity have cloud computing arrangements with significant implementation fees? Again, there's been over the past, say, 10 years or so, there's been a big increase in prevalence of CCA arrangements and that kind of thing. And from my experience, It depends on how big that particular contract is relative to your other contracts. But if it's a very big platform that you're getting into, sometimes there could be some significant implementation fees. And that creates a whole host of issues, both for the CCA provider, that is, how do they recognize that for revenue? And as it relates to this ASU, for the recipient of that CCA, how do I account for those implementation fees? And so now we have kind of clarity on that. And as I'm seeing, most people replying, I'm seeing, 50% say, no, we don't have significant implementation fees. And about 25% say, yeah, we do. And another 25% are like, yeah, we don't know. So obviously that's something that's required. So if you're not quite sure, it's definitely something to try to take an inventory of what all are your CCA arrangements. So the next ASU I want to talk about is 2018-17. And this deals with VIE, so variable interest entities, all right? And this only applies to private entities. That's a very important part, that very first bullet. And the second one is optional, though I anticipate almost everyone wanting to use this. And the reason why is VIE guidance basically says is, if I have an investment in a company and my investment's less than 50%, say the voting interest model, less than 51%, and I don't have control from a voting interest perspective, I have to also analyze it from a VIE perspective. And I have to determine if the investment vehicle, the company I'm investing in, is a VIE. And then if I'm the primary beneficiary, and there's a whole very complex host of things that you have to consider. And what this says is that you can elect, if you're a private company, to not consolidate, not apply VIE guidance to entities that are under common control. And I highlight and emphasize the word common control because if you're under, say, common ownership, so you have same, owners and they just have different percentages, but not any particular owner or group of owners controls, you couldn't apply this. So if you have common control between the reporting entity and the VIE entity that you're analyzing or would have analyzed, you can elect not to apply VIE, and so you would not consolidate that potential VIE. Now, you have to apply this consistently. You have to disclose this, and then you need to also determine if there's any kind of indirect interest held through related parties under common control, and you would recognize that through a proportional basis when you're analyzing your primary beneficiary analysis. So that's the other kind of a small tweak that it did. It is effective for fiscal years beginning after December 15th, 2021, so this coming year end. It would be applied retrospectively with a cumulative effect adjustment. So if you had previously consolidated an entity, you would not have to, you would undo that consolidation. And early adoption is allowed. Of course, now we're at a point where you have to adopt it, but back when it was initially issued, I anticipated and saw that many folks did early adopt it because it made things much easier. So we've talked about SAS 134 to 141, the reporting changes. We talked about all the ASUs that were issued in 2021. There's 10 of them, many of them you want to early adopt. We just went over some of the ASUs that are effective for this coming year end. And now we're going to talk about, lastly, some ASUs that are going to be effective beginning in January. So these are ones that aren't going to be reflected in your, if your calendar year end, they aren't going to be reflected in this current reporting period, but will be next year. And of course, the big one is ASU 2016-02, which is the new lease standard. And this deals with 842. And I'm sure you guys are tired of hearing about it. I'm just going to briefly talk about it. If you're not already aware of it, definitely need to get aware of it. And if you're not already along the way of implementing it, then you need to definitely move on that. And what this ASU did is it basically said, there used to be 4 capital versus operating bright lines that would that you would have to apply to determine whether it was a capital or operating lease. And that's replaced now with kind of 5 principles-based criteria. Though in practice, most people are still going to apply those red lines as a matter of accounting policy, but you're not required to in the accounting standard. And what it basically says is that you determine the lease term, which is all your renewal options that are reasonably certain, which I defined earlier as basically considering 90% or greater, being exercised. And for lessees, you no longer have a capital versus operating. You now have short-term leases, which you would not have a balance sheet impact. Those would be leases that are have a lease term of less than 12 months. And then you have either operating or financing, and operating or financing would have a balance sheet impact, an ROU asset and a lease liability, and the determination of whether it's operating or financing would have an impact on the pattern of expense recognition, but the balance sheet would still have an ROU asset and lease liability. The second to last bullet point, lessor accounting didn't change a whole lot. You're going to have operating or financing, or should be sales type and financing leases. And then you will apply this under the modified retrospective adoption. So that's something that hopefully many folks are already aware of. The next ASU that's effective for 2022 and ongoing is 2019-12. And this one deals with simplifying. I look at that humorously because income taxes always perplex me. I'm an auditor, not an income tax or a tax accountant. So it's supposed to simplify the accounting for income taxes. And I'm not going to pretend to know all the nuanced details of this since, as I mentioned, I'm an auditor. I know enough to be dangerous on this. But basically, there's a lot of different exceptions to income tax basis accounting, especially as it relates to like interim periods and that kind of thing. And so I'm just going to go over some of the higher level ones here. And so the first one I want to go over in any kind of detail would be the second, the very last bullet point, excuse me, which is the accounting for an interim period when there's a year-to-date loss, right? So under interim period tax model right now, you would basically estimate your annualized current effective tax rate, and you would apply, you would do that each interim period, and you would apply that rate to your year-to-date income or loss. And so when there was a loss, it kind of created a situation where if I have a loss during the quarter, but I don't expect to have it at year end, what do I do? Do I not record an income tax benefit or whatnot? And so what this basically does is it says that you can recognize an income tax benefit if you have a loss in the current quarter, but your expected loss is not going to be as much, or it's going to be an expected income or something. So you are able to look at it just from that quarter, and you don't have to, if it's a loss, you don't have to apply that annualized current effective tax rate. And then a lot of other changes too. For example, the one here that I think is maybe most applicable to you all might be that if you have non-taxable entities. So if you have a consolidated entity and you have individual financial reports that are issued standalone for the subsidiaries, it used to be that you had to consolidate, that the consolidated income tax would be recognized and allocated to each of the members of the consolidated group. And there's a little bit of a question of like, what does members mean? Like if I have a entity that's non-taxable, why would I have to, on the standalone financial statements for that entity, allocate some amount of my tax expense or benefit to that non-taxable income? And what this says is that if it's a non-taxable income that's not recognized or disregarded, I should say, under the tax rules, that you don't have to apply, allocate that consolidated income tax number to that non-taxable, non-recognized entity. So that kind of makes a lot of common sense. This is effective for fiscal years beginning after December 15, 2020 for public business entities. And for most folks that are private on listening, it's for fiscal years beginning after December 15, 2022. Early adoption is permitted. And again, this is a clarifying thing, so probably most will adopt that. We're going to briefly talk on some of these other ones here. 2020-01, basically what this one did is it tweaked 2016-01, and it basically says that if you have a equity method investment that's going to go to cost method or vice versa, that is an event that you need to analyze and determine whether or not it creates an impairment. So 2016-01 said that you could recognize some things under the cost basis if they didn't have a readily determinable value. And this says that you would have to recognize that change from equity method to cost method as an event that you would have to analyze whether there's an impairment. And it's effective for public business entities for fiscal years beginning after December 15, 2020, and for all other entities for fiscal years beginning after December 15, 2021. Early adoption is permitted, and I expect most people to early adopt it since it clarifies things. My last question for polling is, are you ready for ASU 2016-02, the new lease standard? And as I mentioned very briefly on this, hopefully you guys are ready for that. It is definitely not going to be deferred anymore. I don't anticipate that. So hopefully we get a lot of yes answers. I know that not everyone's quite there. It looks like from the polling that we have maybe 30% saying, no, I'm not ready, 20% maybe, which I think is probably the right answer for a lot. We think we're ready. We'll know when we get there. The biggest thing I would say when you start with, 842 is one, gain an understanding of it, right? And then really coming up with a complete listing of all your leases is probably the second biggest step. And then the third one I would say is coming up with your policies and how you're going to determine your lease term. I think that's going to be kind of the biggest subjective judgment that you're going to have to make is what are my lease terms, that kind of thing. So let's round out here with a few ASUs. 2020-06, this deals with conversion, debt that has conversion options, right? And what it does is it eliminates the beneficial conversion feature, right? So you no longer have to account for that or a cash conversion feature, but you are, the very last bullet point, required to disclose the conditions or events that could create a conversion, right? And who and what party controls that. This ASU is effective for fiscal years that are beginning after December 15th, 2021 for public business entities. So this coming 2022 for public. And for private entities, it's going to be effective for fiscal years beginning after December 15th, 2023. All right. So it's a ways off. Is early adoption allowed? Yes, but you can't do it before fiscal years that are beginning after December 15th, 2020. All right. I expect most folks to want to early adopt this since accounting for beneficial conversion features is added cost, that kind of thing. And the last couple of issues is 2020-07. This one deals with not-for-profit entities and how they present and disclose contributed non-financial assets. Okay, so these are, maybe works of art or services, that kind of thing, right? You need to present contributed non-financial assets as a separate line item on your statement of activities, apart from other contributions of cash and other financial assets. And you need to disclose your contributed non-financial assets by category, right? And then in addition to that, you need to disclose for each of those categories that you disaggregated by some qualitative information, what the non-for-profits policy is about, cashing those in, a description of any kind of donor-imposed restrictions, and the principal market that you use to arrive at fair value, that sort of thing. And so this is effective for annual reporting periods beginning after December 15th, 2021. And early adoption is permitted, and I anticipate most want to early adopt it since it's clarifying. And it should be applied on a retrospective basis. So there's a lot of ASUs there. I'm sure there are some questions in the chat pod that just impossible to get through. If you have any questions and you haven't been answered, we will reach out to you and try to answer them. I want to thank everyone. If you want to email me personally, you can see my email address there. I just want to thank everyone for attending, and hopefully you learned some things, or at least learned that something has changed and you need to investigate a little bit further. And with that, I want to thank everyone and wish everyone a great holiday season. Thank you so much.